ఓకే సార్, స్టార్ట్ చేయండి.
So hi, hello everyone. I wish a good day to all the viewers. So last session we have begun a discussion of our basic provisions. We have completed basic concepts, residential status, salary head, house property head, and PGBP to some extent up to additional depreciation. We had a discussion yesterday. So now we are going to revise the balance concepts of PGBP, capital gain, and other sources. So heads of incomes, we are going to make a special concentration today. So now let me take the screen. Yeah. So the next element that we are going to discuss is investment allowance, section 32D. We are going to have a discussion on investment allowance, section 32D, 32AD. Sir, what is the difference between additional depreciation and investment allowance? Depreciation we are going to reduce from the block, whereas this investment allowance we are going to directly deduct from computing the income. That means we begin with net profit as per books of accounts, out of which directly we can reduce this investment allowance under section 32AD. Sir, investment allowance means in order to encourage the SSEs who were in manufacturing business. Sir, what should we manufacture? It's at your wish. Any type of product you can manufacture. SSEs who were engaged in manufacturing business, in which area, sir? In notified backward areas. SSEs engaged in manufacturing business in notified backward areas. What are the notified backward areas? Here we have a list. For examination purpose, you need not remember the names. In exam, they will directly give whether the area is notified or not. Okay. Here, what was given here is in notified backward areas, if SSE is going to start the business. Which business? Manufacturing business. For that manufacturing purpose, what he need to purchase? A plant and machinery. Sir, this section is going to get end by this year. By this 31st March 2020, this section is going to get end. So the last chance of asking question in examination is this November attempt only. So this section 32AD might be asked for this November exam, because for next year onwards, this section do not exist at all. This section is only for this year only. So if you observe, any plant and machinery purchased between 2005 to 2020. So up to this 31st March 2020 only, we have this deduction. Sir, we have to purchase a new plant and machinery. In such a case, out of its actual cost, we can claim 15% of the actual cost as deduction. If you observe here, what is the deduction we get here? 15% of actual cost. Sir, we get depreciation normally. We also get additional depreciation. In notified backward areas, if we start a business, what we will get? We will get a additional depreciation also. How much we will get additional depreciation? Actually, 20% of actual cost is the additional depreciation. But if you start in notified backward areas, how much we will get? 35% of the actual cost we get additional depreciation. So normal depreciation 15%, additional depreciation 35%. Along with that, under section 32AD, you will also get 15% of the actual cost. 15% of the actual cost, additional deduction you are going to get, which is called as investment allowance. Which is called as investment allowance. So if you observe here, ineligible plant and machinery list, same as additional depreciation, must be a new plant and machinery, sir. It must be a new plant and machinery. Second hand goods and vehicles were ineligible. It must be used for the purpose of what? Manufacturing. For that purpose only, they are giving you investment allowance under section 32AD. So here we have ineligible plant and machinery list, same as in additional depreciation. Sir, why we are giving this deduction? Because you are purchasing a new plant and machinery and you are using it for the purpose of manufacturing. But here we are imposing a lock-in period of 5 years. If you are going to sell the asset within 5 years, then we are going to treat it as income. The deduction which was earlier allowed shall now be taxable under the head PGB. Okay. And next thing, exceptions to lock-in period. Sir, actually within 5 years, minimum 5 years, we have to hold this asset. But there are certain exceptions like amalgamation, demerger, conversion of proprietor company, sole proprietor into companies, conversion of partnership firm into companies, and unlisted companies to LLP. Sir, in this case, whether the asset ownership will be transferred or not, yes, upon amalgamation from one company to another company, the ownership goes. Even the ownership goes from one company to another company, nothing is taxable. Here within lock-in period of 5 years, if we sell, what I have said to you, it is taxable, but nothing is taxable. We are specifying if the transfer is made by way of amalgamation, demerger, or conversions. Okay. Next, notified backward areas means West Bengal, Andhra Pradesh, Bihar, and Telangana. These are the 4 notified backward areas. In that, these districts were notified, sir. If we start a business in these districts, manufacturing activity, we can claim investment allowance under section 32 AD, which is the additional benefit to us. Okay. So now coming to the next thing. Unabsorbed depreciation. Sir, what do you mean by the term unabsorbed depreciation? Sir, if we get a loss, if you see this abstract of P&L account, here we got a loss of 8 lakhs. This loss, after writing depreciation of 5 lakhs, we got 8 lakhs loss. In this case, what happens if I didn't write this depreciation? If I don't write this 5 lakhs, then loss will be how much? 3 lakhs. That 3 lakhs is called as the business loss. 5 lakhs is called as the unabsorbed depreciation. Sir, why are we separating the unabsorbed depreciation and business loss? Now, first let us see this case 2 also. This case 2, if you see, net loss is 3 lakhs, depreciation debited to P&L is 5 lakhs. In this case, if I didn't write this 5 lakhs, what happens? This loss of 3 lakhs will be converted into profit of 2 lakhs. That loss of 3 lakhs will be converted into profit of 2 lakhs. That means there is no business loss. There is only profit. And what is the unabsorbed depreciation, sir? In this case, we have 2 lakhs profits, 5 lakh depreciation. So 2 lakhs we can absorb. Balance 3 lakhs is the unabsorbed depreciation. Like this, we are going to separate business loss and unabsorbed depreciation. Sir, why are we separating business loss and unabsorbed depreciation? Because there are 3 differences between business loss and unabsorbed depreciation, which is very important theory question. So let us please refer this one. Sir, generally business loss can be carry forwarded for how many assessment years? 8 assessment years. Whereas unabsorbed depreciation can be carry forwarded for any number of years, no limit at all. For 20, 30 years also we can carry forward. So that's why we need to separate. And next, business loss can be carry forwarded only if the return of income has been filed within the due date. If you are filing belated return, business loss cannot be carry forwarded. But unabsorbed depreciation can be carry forwarded even the return has been filed belatedly. So belated returns also you can carry forward the losses. Generally there will be the due date 31st July, for tax audits 30th September, international transactions 30th November. These are the due dates of filing return of income. By that date, if you have not filed, then business loss, if any, it will be lapsed. That means it cannot be carried forward. But unabsorbed depreciation, you can carry forward even the return has been filed belated. Next, carry forward business loss, we have to set off only against business income only. This is one of the set off rule. If we are any carry forwarding any business loss, we must set off against only business income. But here if you see, unabsorbed depreciation can be carry forwarded and set off against any income except salaries and casual incomes. This is one of the set off rules, sir. Unabsorbed depreciation can it be set off against house property income. Yes, any head of income you can set off. carry forward business loss should be set off against current year business income only. Whereas carry forward unabsorbed depreciation can be set off against any head except salaries and casual incomes. The main thing which has been focused here is except salaries and casual income, you can set off it against any head. Sir, is the difference clear? Since these three differences exist between business loss and unabsorbed depreciation, we have to separate business loss and unabsorbed depreciation. That is the main intention. So I think I am very clear with the issue. So now let us continue. Depreciation in case of power sector units. Sir, what is the next item? Power sector units. What do you mean by the term power sector units? That means companies who were engaged in generating power, manufacturing power. AP Genco project we can take example. Lanco project we can take example. These are power manufacturing units. They generate electricity. So the thing which was specified here is the SSEs who were engaged in the business of generating electricity, they have two options. Generally, which method we should follow for the purpose of section 32 depreciation? WDV method only. But the SSEs who were engaged in the business of power sector units can claim depreciation either under WDV method or SLM method. Any of the method they can choose. Either WDV method they can choose or SLM method they can choose. But once chosen, it cannot be opted back. Sir, is it better for the SC to claim WDV method or SLM method? Sir, SLM method block can be 0, but WDV never becomes 0 until it has been sold. So that is the difference. It is at your wish whether you follow straight line or WDV. But if you want to follow WDV method, block of assets method should be followed. In case of power sector units, depreciation can be claimed either under WDV method or SLM method. But if you follow WDV method, if this option is opted, then block of assets method should be followed. But if you want to follow SLM method, if this method is opted, then depreciation shall be calculated based on useful life of the asset. What was being specified here is based on the useful life of the asset, here depreciation shall be calculated. So is the provision clear? Right. If we continue, this is just a general example regarding that. So next, if there is any amalgamation or demerger, then what should we do? Sir, any amalgamation or demerger, if you see in your accounts, amalgamation demerger will be taken at the end of the year or beginning of the year. But practically today the date is 21st September. Can today one company get amalgamated with another company? Yes, practically everything is possible. But here the question is, up to today, up to yesterday, who has used the asset? Previous amalgamating company. From today onwards, who is using the asset? Amalgamated company. That means earlier amalgamating company is using, now amalgamated company is using. So who is eligible to claim depreciation is the question. So for some days, buying company is using, for some days, selling company is using. So who has to claim depreciation in this case? What has been specified here is you compute the depreciation had such succession or amalgamation has not taken place. What has been considered here is had such amalgamation or succession had not taken place. So you have to compute the depreciation had such succession or amalgamation had not taken place. So that, like that you compute first. That means you compute depreciation for entire year first. You compute depreciation for entire year first. After computing the depreciation, what now we have to do is based on number of days of use of asset, you have to divide. Based on number of days of use of asset, we are going to apportion the depreciation among the predecessor and successor. Based on which one, sir? Number of days of use of asset, we divide among the predecessor and successor. So that is in case of amalgamation and demerger. Okay. So next thing here is so after section 32, we are entering into section 33. Tea, coffee, and rubber development account. Actually, this is the major product which we are exporting from our country. We have to encourage exports so that foreign currency will realize into India. and our country also is going to get developed. So here what they are specifying is if SSE is engaged in business of growing and manufacturing tea, coffee or sugar, not only selling, you have to cultivate and manufacture tea. That means we have both business income and also agricultural income. Growing is agriculture, manufacturing is business. Sir, we have rule number 7, 7A, 7B and 8. 4 rules we have to separate business income and agricultural income. For growing and manufacturing tea, 60% is considered as agricultural income, 40% is considered as a business income. The standard rates were given in rules, rule 7 to rule 8, 7, 7A, 7B and 8. But before such division, before dividing agricultural income and business income, you can claim deduction equal to 40% of our PGBP income. Out of our profits, we can claim 40% of the profits as deduction because we are in the business of manufacturing tea, coffee and rubber. But for this purpose, what you have to consider here is you have to deposit the amount in NABARD, agricultural bank. In NABARD, you have to make a deposit. Why, sir? This deposit has to be used for purchase of a new plant and machinery. So deposit the amount before the expiry of 6 months. From the end of the year, within 6 months, you have to deposit, or if you are filing early return of income, by that date you need to deposit. So you have to get audited by a chartered accountant. Chartered accountant should have to submit form number 3AC whether you have deposited within the time or not. Okay. Can we withdraw, sir? Yes, we can withdraw from the scheme only for the specified purposes. Specified means we have to purchase a new plant and machinery which is to be used for the purpose of manufacture. If you purchase a plant and machinery to be used in office premises, it's ineligible. If you purchase any office appliance, it's ineligible. If you purchase any plant and machinery, already 100% deduction. If you use for scientific research, you can claim 100% deduction. Like that, if you purchase also, you are ineligible. They are specifying eligible or ineligible. You will be ineligible. Next, there are certain products which were given in 11th schedule, like alcohol, chocolates. So these types, some of items were specified in 11th schedule of Income Tax Act, where you are ineligible to claim the depreciation. We are ineligible to claim this section. This section you cannot claim. That means 33AB deduction you cannot claim if you manufacture those items. Those items which were specified in which section? 11th schedule has been considered here. So finally what I am saying is 33AB is giving 40% deduction when if you deposit the amount with NABARD within 6 months from the end of the year, you can claim 40% deduction. That's what the thing which has been specified in this case. Okay. So next thing, if any amount is withdrawn on closure of business, it will be treated as deemed profits. You should not close your business. You have to purchase a new plant and machinery, and that new plant and machinery should be used for 8 years. 8 years is the lock-in period which has been specified here. 8 years you have to use for the purpose of manufacturing. What happens if I sell, sir? The deduction which you have claimed earlier shall now be taxable. The deduction which you have claimed earlier will now be taxable. That is the meaning. Okay. So now coming to the next thing. Just a minute. Yeah. Now coming to the next section. Site Restoration Fund. Sir, earlier we have discussed section 33AB. What is that one? Tea, coffee and rubber development account. Whereas now if you see, it's a site restoration fund. What do you mean by the term site restoration fund? Sir, site restoration fund means if SSE is engaged in extracting petroleum and natural gas. If SSE is engaged in extracting petroleum and natural gas, in such a case, what you can do here is SSEs who were engaged in extracting the petrol. Here, in this case, we are controlling the import. Earlier, Section 33AB has been introduced to encourage the export, whereas 33ABA has been introduced to control the import. Because in our country, what is the major product that we are importing? Main, this petroleum and crude oil. So if in India manufacturing, if we are going to encourage, automatically imports can be controlled to some extent. That's why they are saying that here 20% of your profits we will give you deduction, provided you have to deposit in a SBI bank account. In SBI, you have to deposit this 20% of your profits, then we give deduction. Sir, what happens if I contribute 40%? Then your deduction will be restricted to 20%. Maximum 20% of your profits you can claim deduction under 33ABA if you deposit in SBI. Here also, for which purpose we have to use this deposit, sir? We can withdraw at any time for purchasing a new plant and machinery. Here also same ineligible purchase, 8 years condition, everything is one and the same. So the main intention of Section 33AB, the main intention of this section, Section 33AB here is AB and ABA to encourage exports and to control imports. Those two sections have been introduced. And next, very, very important section of PGBP. What is that one? Section 35. So which is a very, very important section. So now let us have a view regarding this one. Sir, in section 35, we have 8 topics for discussion. Scientific research, donation, section 35 AD specified business, preliminary expenses, telecommunication license fee. Okay, so like this we have a total of how many? We have a total of 8 topics to be discussed in this chapter. So let us have a discussion. So let us have a discussion on this element. So first speaking, scientific research. Sir, scientific research here, they are specifying that in case of the scientific research, we can do our own research or we can make donation to others. Either we can do our own research or we can make a donation to others. Sir, what happens if I do my own research? Sir, if I do my own research, any expenditure incurred, can I claim deduction is the question which is been arising. And second part, if you see, I can contribute to others, like donations I can give to others. So first let us see our own research. For our own business, if I do any research, before commencing business or after commencing business. Before commencing business, all the expenditure incurred, you can claim deduction after commencement, provided last 3-year expenses only. Sir, from past 10 years we are doing research, sir. Can I claim that 10 years expenditure now? No. Maximum past 3 years expenditure only. Now you can claim it as deduction. When you have to claim after commencement of the business, what has been specified here is after commencement of the business, you can claim deduction. Sir, whether in 5 installments? No, immediately you can claim. There is no concept of installments here. Next, the second part is after commencement of the business, can I claim this deduction? Yes. After commencement of business, if the SSE is a company plus manufacturing any article, company plus if it is manufacturing any article, then on capital expenditure, land no deduction because land is not an expenditure. Land is an investment. That's why land you cannot get any deduction. In buildings, if you invest, that building is used for the purpose of research activities. In such a case, you can claim 100% deduction. What has been specified here is here you can claim 100% deduction. Other assets, any plant and machinery if I have purchased 150%. That means if I have spent 1 lakh, 1,50,000 I can claim deduction. If I have spent 1 lakh, how much I can claim? 1,50,000 I can claim deduction in this case. Okay. Now coming to the second part. Any revenue expenditure also they can claim 150% deduction. Sir, first of all, who is the SSE? SSE is a company. If SSE is a company and If SSE is a company and what the activity it is doing, if it is engaged in manufacture, then we can claim high deduction. 150% we can claim. But on building only 100%. Land and machinery, can I claim 150%? Yes. On land, no deduction at all. Okay, sir. This is own research. Own research done after commencement of business. If it is an individual who is doing research, then on all the capital and revenue expenditure 100%, excluding land. Land we cannot get at all. Sir, what is the main difference is for companies engaged in manufacture, they can claim 150%. For companies engaged in manufacture, they can claim 150%. But other than companies, maximum how much can they claim? 100% only they can. That is the main difference. Next, second part. If we contribute to others, what is the second part, sir? If we contribute to others, what shall we do? Contribution to social or statistical research, we can claim 100% deduction. Any research institutes doing social and statistical research, if to that institute, if I donate, I can claim 100%. Sir, is it related to my business? No. Even though it is not related to my business, I can claim deduction. That's what the thing which has been specified here. So this is contribution to other persons. Second part, contribution to Indian company with an objective of scientific research. If we contribute to Indian companies with an objective of scientific research, here also we can claim 100% deduction. Approved scientific research institute. Sir, do you remember? Approved any institutes like IIT, Indian Institute of Science and Technology. IIT, if I contribute, can I claim this deduction? Yes. If you contribute to approved scientific research institute, 150%. Contribution to National Laboratory or IIT, Indian Institute of Technology. IIT, Indian Institute of Technology. Here you can claim how much, sir? 100% deduction you can claim. You can claim not 100, 150. 1 lakh if I donate, I can claim 1,50,000 as deduction in this case. So I think this part is very clear. First part, own research. Second part, contribution to others. Both the things we had a discussion now. Next. Sir, what happens if I donate to other entities? Number one, if I donate to any project notified by government, any flyover if government wants to construct, they can accept donations from public. Sir, these are not loans. These are not deposits. They can accept donations from the public. And they give that if you donate to this project, you will get 100% deduction. Okay. Next, approved rural development programs. What has been specified here, sir? Rural development programs, any program for developing any rural area, if government has approved, here we can claim 100% deduction. Sir, many of the heroes now, they are adopting villages. So earlier Mahesh Babu has adopted. Now recently Prabhas has also adopted. Many heroes were adopting villages and they are developing the villages. Does it amount to rural development? Yes. But that heroes cannot claim deduction. Why, sir? Is there any exception? No. If you contribute to government, government has approved any program, if I donate, then I will get deduction. On their own, if they expend, it's just a satisfaction. You cannot claim any tax deductions. So I think that provision is very clear to you. And next, if government approves any agriculture extension project, if government approves any project for the purpose of agriculture development, to that project, if I donate, how much deduction will I get? I will get 150% deduction. Next, notified skill development programs. To encourage any skill, they need any fund. The government can notify a project as a skill development project. If to that project I donate also, 150% deduction is available. But what is the proof that I have donated to these funds? They will give a certificate. That certificate is the basis funds. Okay. And next thing, specified business under section 35 AD. Next section is specified business under section 35 AD. Sir, what do you mean by the term specified business? Sir, here they said 4, 6, 10, 12. Total 12 businesses were given here, sir. What is the benefit which was given in section 35 AD for these 12 businesses? If you see this note 1, for all the above specified businesses, 100% of the capital expenditure you can claim as deduction in the year of commencement of business itself. Sir, is it clear? 100% of the capital expenditure you can claim as reduction in the year of commencement of the business itself. That has been specified here. 100% we can claim as reduction in this case. That means if I spend 1 lakh towards purchasing an asset for this specified business, here I can claim that 1 lakh as reduction. So 100% of the capital expenditure is eligible for deduction. If I spend 5 crores I can claim reduction. So what are the businesses specified here? Cold storages can claim any of the capital asset they purchase, they can claim 100% reduction. Next, warehouse, for constructing warehouse, godowns for storage of agricultural produce or sugar. For construction, a lot of expenditure we have incurred. Entire expenditure we can claim in first year itself. So that much expenditure if we write in first year itself, it will lead to a loss. Can I carry forward that loss? Yes. Loss from specified business can be carried forward for any number of years. There is no restriction at all. It can be carried forwarded for any number of years. There is no restriction of 8 years here. Generally, business losses, how many years we can carry forward? For 8 years. But that 8 years restriction do not exist here. Loss from specified business can be carried forwarded for any number of years, but it should be set off against specified business incomes only. It cannot be set off against normal business incomes. It should be set off only against specified business incomes only. That's what the thing which has been specified here. So now let us come back. Coming to the next thing. Setting and upon operating. Number 1, cold chain facility. Number 2, warehousing. Number 3, inland container depot. Sir, what do you mean by the term inland container depot? I will show you one image. Just a minute. So I think you are able to see this image. So here if you see, this is one of the inland container depot. So inland container depot means these types of containers will be maintained there. These type of containers will be maintained there. In movies also we used to see this type, and many of the climax scenes will be shooted here. So in these containers they will store the imports. Much storage space we can save, because if you see box above box, another box was being stored here. This is a container freight station. In order to make these containers, these are iron boxes. It takes a lot of cost. The person who is managing this container freight station can claim entire cost of these containers in first year itself as deduction. In first year itself, we can claim 100% deduction. That's what has been specified here. Inland container depot. Next, semiconductor wafer fabricating unit. What do you mean by the term wafer fabricating unit? Means cell phones and laptops manufacturing, electronic industries. Electronic industry manufacturers we have to encourage, then only imports will be controlled. They can also claim their entire capital expenditure in first year itself. The SSEs who were engaged in constructing pipelines for transporting petrol crude from one country to another country, entire pipeline cost can be claimed as deduction. Next, pipeline constructed for transporting iron. Iron will be converted into liquid form by heating. So through pipeline also they are transporting iron nowadays. So that pipeline construction cost where heating facility is provided throughout the pipeline can also be claimed as a deduction. Next, building and operating. What we need to build, sir? At least 2-star category hotels we need to construct. At least 2-star category. Sir, you don't bother regarding this case class. This is for a final reference. So you need to just listen the theory which I am saying. Hotels takes a lot of construction cost. Entire construction cost of hotels you can claim deduction here. Hospitals with at least 100 beds for patients. So minimum a hospital you can construct. Entire hospital cost you can claim deduction. But how many beds should exist there, sir? Minimum 100 beds should exist. Next, government housing projects, infrastructure facilities. So for to construct roads, bridge, dams, sir, much capital expenditure is incurred. Entire capital expenditure you can claim deduction. SSEs who were engaged in manufacturing fertilizers, honey, beeswax means Let me show you the image. So in so out of honeybees, in Telugu we call it as tenupattu. From there they will extract entire honey and the balance which is left. Let me share the screen. Yeah. So this is beeswax. The balance which is left, this will be left after extracting entire honey. This will be left, out of which they manufacture this beeswax. It will be used as soaps. This will be used as soaps, or in shampoos also. Generally they use this beeswax. If you see here, this is 100% pure beeswax. So many of the bacteria content can get killed here. Okay, so this is called as beeswax. So this beeswax manufacturing also they are encouraging. So honey manufacturing also they are encouraging. Sir, honey we don't manufacture, no, directly we'll extract, no. Yes, but after extracting the honey, some filtration process, purification process should exist. Directly we should not consume. So that is called as production of honey. Any machinery you purchase for filtration, for cleaning, so that machine cost you can claim deduction here. In all these businesses, 100% you can claim deduction. If it leads to loss, what happens, sir? I can carry forward that loss for any number of years. That is specified business. Next, coming to preliminary expenses. Preliminary expenses means we can conduct before commencement of business or after commencement for the purpose of extension of the business. This preliminary expenditure, in how many installments can we claim, sir? In 5 equal installments we have to claim. But there is a maximum limit, sir, for companies. 5% of cost of project or 5% of capital employed, whichever is higher. This amount or actual amount, whichever is lower. This is a case for companies where you can claim 5% of the cost of the project or 5% of capital employed, whichever is higher. That amount or actual expenditure, whichever is lower. This is in case of companies. And in case of other SCs, 5% of the cost of the project or actual expenditure, whichever is lower, you can claim deduction. Because for individuals, there is no concept of capital employed. So that's why 5% of cost of project or actual expenditure, whichever is lower. This amount, in how many installments can I claim, sir? In 5 installments, I can claim as deduction. Okay. So this was regarding preliminary expenses. Next, telecommunication license. Sir, this license, if you treat as intangible asset, sir, Jio, Reliance, so these are all will pay license fee to TRAI, Telecommunication Regulatory Authority of India, TRA. So Idea, Airtel, all these telecommunication network will pay license fee to TRA, Telecommunication Regulatory Authority of India. This license fee paid can be claimed as deduction in 5 installments or 10 installments, sir, based on the license, period. If you see how much deduction can be claimed, in numerator we have to write license fee paid. In denominator we have to write unexpired period of license. So what has been specified here in this case? Unexpired period of license they are specifying here, sir. That means if the license period is for 8 years, yeah, then divided by 8. License is for 5 years, then divided by 5. Like that. Unexpired period we are writing on the denominator. But the main thing to be noticed here is paid. That means only on payment basis only you can claim this deduction. Only if you pay, then only you will get deduction. Not on accrual basis. Only on the payment basis you will get this deduction. That's what the thing which has been clarified here. So if you see this example, first year 3 lakhs he has paid, second year 1,50,000 he has paid. Okay, so there is third year also. So let us assume in third year he has paid 50,000. First year 1,50,000. So second year, first year 3 lakhs. So and second year he has paid 1,50,000, and third year he has paid 50,000. Okay. In this case, how much deduction can he claim? In first year 3 lakhs by how many years of license? 5 years. Second year, this 3 lakhs by 5 plus 1,50,000 he has paid. Now the years will be 4. 1,50,000 by 4. Third year he has gained 50,000. So 3 lakhs by 5, 1,50,000 by 4 plus 50,000 by 3. So like that we write. So based on payment basis, we are going to get deduction. This was regarding telecommunication license. Amalgamation demerger expenditure can be claimed in 5 installments. VRS expenditure also can be claimed in 5 installments. Next, expenditure for extracting minerals. Minerals means coal, iron, these are all minerals. Where these minerals will be? In the soil. Out of soil, if we extract these minerals, that extraction capital expenditure any incurred. If you claim depreciation, it's okay. If you don't claim depreciation, you can claim the expenditure in how many installments? In 10 installments, you can claim this expenditure. If you claim depreciation, it's okay. If you didn't claim depreciation, the deduction for extracting minerals, you can claim under section 35E in 10 equal installments. Other deductions, very simple points. Insurance premium paid on stock, on cattle insurance premium paid by milk cooperative societies. And if employer pays any insurance premium on the health of the employees, sir, not on the life. Employee life insurance if paid by employer cannot claim deduction. Employee health insurance premium if paid by employer, yes, now employer can claim deduction. Now employer can claim deduction. Sir, is it clear? This was regarding insurance premium paid. Next, number 2, bonus or commission. Any bonus or commission paid to employee, we can claim deduction on payment basis. Because here which section has been used? Section 43B. If you remember section 43B, certain expenses were allowed only on the payment basis, in which this section is one of the point there. Only if you pay this bonus, sir, payment means in the year itself we have to pay. No, we have time up to the due date of filing return of income. That is a benefit given by section 43B. There is a benefit given by section 43B. What section 43B has specified is you have the time to pay up to the due date of filing return of income. At least by due date of filing return of income, if we have paid this bonus, you can claim deduction. What happens if I didn't pay? You have to disallow and you have to allow it in the year of payment. Whenever you pay, then you can claim deduction. This was regarding bonus or commission. Next, coming to borrowed capital. So if I borrow capital from my friend and use in business, whether interest paid to a friend, can I claim deduction? Yes. If I borrow capital from bank, yes, I can claim deduction. But if you borrow capital for purchasing an asset, up to put to use interest, what should we do? We have to capitalize. We have to capitalize. Except that thing, remaining all case, the interest paid on the borrowed capital, we can claim it as deduction. So that was regarding interest paid on the borrowed capital. Okay. So next thing, why you have borrowed, officer cannot question, sir. The interest paid, we can claim deduction. But interest payable to banks, public finance institutions, NBFC, 43B applies. That means only if we pay, then only we have to claim deduction. Sir, what about interest payable to friend? That I can claim on accrual basis. For friend, if I want to pay any interest, that I can claim on accrual basis. So in all the remaining cases, only if you pay, then you have to claim it as deduction. Only if you pay, then you have to claim it as deduction. Sir, is that point clear? This is interest payable to banks. Next, if I continue, no deduction shall be available for interest on own capital, interest on money borrowed for payment of tax, interest on late payment of taxes. That means this is nothing but the tax, income tax. On income tax, if you pay any interest, whether that interest can be claimed as deduction, no chance. No deduction is available on interest on own capital, the money for advance tax, so interest payments, these all things you cannot claim it as deduction. So that's what the thing which has been specified in this case. Okay. So now coming to the next thing, let us continue. Zero coupon bonds. Sir, zero coupon bonds will generally be issued at discount and redeemed at face value. From company point of view, if they want to issue zero coupon bond for 100 rupees, they don't issue for 100. The face value is 100. They will issue for 75 rupees only. But at the time of redemption, how much should they pay? At the time of redemption, they have to pay 100. So difference 25 is the loss to the company. That 25 rupees loss per bond per face value, that the company can claim expenditure over the period of the bond. If it is 5 years bond, so 5 years they need to amortize. The discount on zero coupon bond, from company point of view, this is an expenditure they can claim over the period of the bond. And this is the most important thing which I am discussing for your exam. Contribution to Provident Fund and ESI. Sir, can we contribute to PF and ESI? Yes. Any contribution by employer towards PF and ESI, you can claim deduction only on payment basis. But the thing to be remembered is PF, both employer and also employee, both will contribute. Both employer and also employee, both will contribute towards PF and ESI. The thing to be remembered here is employer's contribution is covered in section 43B. Employer's contribution is covered in which sections are 43B. That means you have time up to the due date of filing return of income. You have time up to the due date of filing return of income. If you pay employer's contribution, you can claim reduction. But employee's contribution, if you say, you have time up to the due date of relevant act. What has been given here? Up to the due date of relevant act only you have time here. Sir, what is the difference between that and this one? Sir, here you have time only up to the due date of relevant act. Okay, what has been specified here is relevant act means Provident Fund by next month 15 I have to pay. ESI by next month 21st I have to pay. So that is the time which has been specified. What happens if I do not pay within this date? Permanent disallowance. At least employer's contribution, sir. This year under 43B we disallow and next year we allow. But this one is permanent disallowance. Which one? Employee's contribution, if I didn't deposit within the due date under relevant act, by next month 15th and 21st, if I didn't deposit, it's permanent disallowance. Again, it cannot be allowed account. Okay, next. Employer's contribution, sir, because employee will give to employer first that amount. Employer should pay to government. First, when employee gives his contribution to employer, it should be credited to P&L. Later, if it is paid, it will be debited to P&L. Next, if employer contributes towards employee pension schemes, maximum 10% of salary we can claim reduction. Maximum how much can we claim, sir? 10% of salary we can claim as reduction in this case. Next, contributions to approved gratuity fund. To any gratuity fund under 43B, only if you pay, then only you can claim it as reduction that has been specified here. Next, loss in respect of animals. Sir, if you see dairy farming, Telugu we call it as Palakendra. So there, what is their main asset? Cattle. That cattle they have purchased each cow for 1 lakh rupees. Whether that on cow can we claim depreciation? No, it's a living asset and living organisms. We can't claim depreciation. Then cow is an expenditure to the dairy farming. When can that cow expenditure of 1 lakh can be claimed as deduction? When it become died or permanently useless. Whenever that cow has incurred his death, then what we will do? Its carcass, dead body also we can sell to leather manufacturing companies. I got 10,000 rupees. I have purchased it for 1 lakh. Now upon sale of carcass, how much I got? 10,000 rupees. This difference, 90,000 now can be claimed as deduction. Actual cost minus carcass. That means dead body. So the difference 90,000 we can claim as expenditure. Finally, what I mean to say is when the animal's cost can be claimed as expenditure, when it becomes permanently useless, then you can claim expenditure. Next, bad debts written off. Sir, bad debts can be claimed expenditure. Yes, the bad debts which were written off, we can claim expenditure. Earlier, when we are selling any products, what the entry we write? Debtor account debtor to sales. Generally, we write debtor account debtor to sales. That means we have already considered it as income. Sales we have already considered it as income. That thing, if we pay, that means if he does not pay, for customer don't pay to us, it's a bad debt to us. So that bad debt you can claim expenditure on a condition that earlier you have to offer it as income. Then only now you can claim it as expenditure. Next, provision for bad and doubtful debts. Sir, whether initially before becoming bad debt only, can I create a provision? Before becoming bad debt itself, can I create a provision? Is the thing which has been specified here. Yeah, yes sir, you can do. Yeah, yes, you can do, but this deduction is available only for banks and financial institutions. I cannot claim this provision for bad and doubtful debts. Only if the debt has become bad, then I have to claim the deduction. Whether provision can I claim? Directly I can't claim. When can we claim provision? That has been specified here is provision for bad debts is allowable only in case of banks and financial institutions. How much can they claim this provision, sir? 8.5% of their gross total income plus 10% of roll advances. This is in case of banks which were incorporated in India. Foreign banks, NBFCs, public financial institutions, remaining all maximum, how much then can they claim, sir? Only 5% they can claim remaining all. So only Indian banks 8.5% plus rolled advances 10% they can claim. This is the maximum provision allowable in case of banks and financial institutions. Next, number 11. Transfer made to special reserves. Sir, banks in your accounts group 2, you might have learned banking companies accounts. There many provisions we create like statutory liquidity ratio, cash reserve. We use it to transfer many amounts to the special reserves. Whether all those amounts can be claimed as deduction? No. Here what they are saying is deduction shall be least of the following. Maximum 20% of your PGBP income or the profits you are transferring. Maximum twice your capital plus reserves. Maximum how much can be transferred? Twice. The twice amount or 20% of our business profits or actual amount we have transferred. Whichever is lower, you can claim as deduction. In future, if you withdraw, then it is taxable. Since whenever you are transferring, we are claiming deduction means when you withdraw, it will be automatically taxable. Next, expenditure incurred by company for promoting family planning. Family planning expenditure, capital expenditure can be claimed in 5 installments. Revenue expenditure immediately you can claim. Next, securities transaction tax, commodities transaction tax also can be claimed as expenditure. If our business itself is trading in shares, then STT paid, CTT, commodity transaction tax paid, we can claim it as deduction. So up to now, section 30 to 36 are specific, sir. Remaining all like salaries, purchases, advertisement cost, these all things we didn't discuss. Whether can we claim these items also as deduction? Yes. Under which section? Under section 37, we can claim general deduction. It should not be a personal. It should not be a capital. Revenue expenditure only we have to claim. If it is incurred for the purpose of business, wholly and exclusively for the purpose of business, then you can claim this deduction which has been specified in section 37. But any offense or prohibited persons, if you pay bribe to police, can I claim it as expenditure? No, it's an offense. Any offense or prohibited expense we cannot claim. If department levies any penalty, GST department, if they have levied any penalty as on us, whether can I claim that penalty as deduction? No. Offense or prohibited purpose, you cannot claim deduction. Next, CSR, corporate social responsibility. Every company, out of their profits, 2% of the profits should be spent towards CSR. CSR stands for corporate social responsibility. Whether that CSR expenditure can they claim? No. Because it's a regulation in Companies Act. It's not an income tax act. That CSR expenditure, that means donations or public activities they need to spend. If they do not spend under Companies Act, they are going to levy penalty. But as per Income Tax Act, only business expenditure we allow. That expenditure you have incurred, for which purpose? Only for the purpose of your Companies Act benefit. So that's why the CSR expenditure is not related to your business. We are not going to allow the CSR expenditure. Sir, can I claim advertisement expenditure? Yes. But advertisement expenditure in the magazine published by political party, you cannot claim. Political party magazine, you cannot claim it as expenditure. In political party brochures, pamphlets, if you make any payment to them to advertise, then you cannot claim it as deduction. Normal advertisements you can, but during politics, any political party brochure, if you advertise, you cannot claim it as deduction. Okay, this is section 37, general examples. Next, section 38. Sir, any common expenditure for business and professional and also personal? Whether can I claim proportionate business expenditure? Yes, sir. Building I use both for office and residence. Okay. Now, whether can I claim full rent as expenditure? No. Based on the annual value of the premises, you have to divide how much for personal, how much for business. Proportionately, you should claim. Any other expenditure also, proportionately, you have to claim. That has been given in which section, sir? In section 38. Next, section 39 is omitted from the Act. So next we are entering into section 40. So there is some disturbance here. Let us come back. Yeah, I will show you here. So this is section 40. Disallowances. As of now, what we have learned is allowances. Now I am coming for disallowance. The main thing is TDS. On any expenditure you have incurred, there are certain TDS sections. Interest section 194A, rent payment section 194I. There are certain TDS provisions. So upon payment, if you do not deduct TDS, then your expenditure shall be disallowed. TDS is a mandatory. So what are the circumstances in which we have to deduct TDS? Is been specified in TDS section, section 192 to 196. But if you do not deduct TDS, what happens? On payment to resident, if you don't deduct TDS, 30% of your expenditure shall be disallowed. On payment to non-residents, if you do not deduct TDS, 100% of your expenditure shall be disallowed. So resident payments, if you don't deduct TDS, 30% will be disallowed. Non-resident payments, if you don't deduct TDS, entire expenditure shall be disallowed. So don't make violations, follow it promptly. What happens if I do not deduct TDS means it will be disallowed. Sir, next year if I make payment, can it be allowed? Yes. Next year if you make payment, again you can claim deduction. Next, 48.2. Disallowance of payment made to whom, sir? Relatives. Sir, if you make any salary payment to your relative, but if it is excessive and unreasonable, you can make payment. If he is our employee, you can make payment to the relative. But if you pay excessive to reduce the profits, that we will not allow. Any excessive over fair market value, any excessive payment over the need, any excessive payment over the benefit derived. From whose point of view? From assessing point officer point of view, any expenditure you make which is excessive and unreasonable. Sir, what is the term which has been specified here? Excessive or unreasonable from assessor officer point of view. Then what will he do, sir? What the assessing officer will do now? He is going to disallow the expenditure. He is going to disallow the expenditure. This is relative definition. Next, very important provision. In a day, revenue expenditure. Sir, capital expenditure, if I spend more than 10,000 in cash, depreciation will not be allowed. In last session, yesterday we have discussed. Capital expenditure, if you spend more than 10,000 in a day, depreciation will not be allowed. Sir, what about revenue expenditure? Any revenue expenditure you spent in excess of 10,000 in a day, what happens, sir? That expenditure shall be disallowed. Sir, can I purchase printing and stationery 16,000 rupees in cash? If you make payment in cash, that 16,000 will be disallowed. That 16,000 will be disallowed. Whenever your expenditure exceeds 10,000 rupees, you have to make payment by way of bank draft or ECS. You have to make the payment by way of a bank draft or ECS. If you do not do, it will be disallowed. Okay. Of course, for freight, we pay 35,000 limit is introduced. If I want to pay freight for the purpose transportation charges, up to which extent I can pay in cash, up to 35,000 you can make payment in cash. But there are exceptions. If I make payment to government, can I make cash? Yes. Sir, through debit card or credit card, can I make payment? Yes, sir. Google Pay, I have transferred. Telegraphic transfer, is it permissible? Yes. These are exceptions. Sir, I can make payment to farmers in cash. Yes. So if I want to make payment in any village or town where no bank exists, yeah, I can make payment in cash. Employee retirement benefits, I can make up to 50,000 in cash. Any gratuity, leave salary like that, 50,000 we can make payment in cash. So any holiday or strike, we can make payment in cash. If we make payment to agent and agent gives to principal, we can make payment in cash. These are certain exceptions, sir, regarding this 48. Next. Provision for gratuity cannot be claimed as deduction. Only gratuity paid can be claimed as deduction because this is subject to 43B, sir. So provision made not allowed. If you pay gratuity to retiring employee, yeah, you can claim deduction. Next. Contribution to non-statutory funds. Any festival fund has been started by employees. If employer contributes towards that festival funds, can I claim deduction? No. Contribution to non-statutory funds, you cannot claim deduction. Is it clear, sir? Not allowable. Next. Section 41, deemed profits. Sir, earlier if we have claimed any expenditure, let me take bad debts as example, sir. Here, bad debts we have already claimed it as expenditure. Okay, if that bad debt is recovered, bad debts we have already claimed as expenditure, but later if that bad debt is recovered, we have to treat it as deemed income. That is section 41. Earlier, any expenditure you have allowed, sir, now it has been recovered. We have to treat it as business income. Business income. Next, section 42 is at final level. You can skip it. Next, now we are coming for section 43. Number 1, 43B, very, very important. Disallowance of certain expenditure like bonus, employer's contribution. Employee contribution, we have due date up to relevant act only. Employer's contribution. Next, any leave salary, gratuity we pay. So these are all were subject to 43B. That means only if we pay them to the employee within the due date of filing return, then only we can claim them as deduction. Taxes like sir, income tax, wealth tax, they are disallowed, which we already know. GST, business payment, can we claim deduction? Yes. Municipal taxes, yes. If the building is used for business, municipal tax also you can claim deduction under the head PGBP only. Any tax, duty, cess, fee, by whatever name called you pay, only if you pay you can claim it as deduction. That means on accrual basis or payment basis? On payment basis. Only if you pay, then you can claim it as deduction. Sir, is it clear? Expenses relating to government. Next. Borrowed capital, this we have already discussed. To any banks and financial institutions, if you pay, only if you pay, then only we can claim it as deduction. Okay. So next, very, very important provisions are section 43CA. Conversion of, land and building, if we are holding it as a stock in trade. Sir, now land and building is not my asset. If land and building is my stock in trade, then what should I do, sir? If it is sold at a price less than stamp duty value, 50 lakhs value of land, my stock in trade, can I sell it for 30 lakhs? Yes, you can sell it. But you have to consider 50 lakhs only as income. If you sell, sir, 5% variation is permissible, sir. How much variation permissible? 5%. Exactly, no one can sell. So below stamp duty value, if you sell 5% variation, okay. More than 5% if there is a variation, what shall we do, sir? We are going to we are going to consider the stamp duty value as the full value of consideration. Sir, 50 lakhs value of building, if I sell it for 30 lakhs, then what shall we do? Entire 50 lakhs we will treat as a business income only. We will not consider 30 lakhs. Sir, is variation permissible? Yes. To what extent? 5% variation is permissible. More than 5% if there is a variation, we take stamp duty value as the full value of consideration. Sir, stamp duty value on the date of agreement or on the date of registration? Which one we need to take, sir? Stamp duty value on the date of agreement or stamp duty value on the date of registration? Sir, in this case, stamp duty value on the date of, if you make any advance payment, then on the date of agreement date, stamp duty value you need to consider. If you do not make any payment, then stamp duty value on the date of registration you need to consider. Is it clear, sir? Whether agreement or registration means it depends upon this one. Next. Sir, what happens if land and building is a capital asset? If it is a capital asset, which section we use, sir? 50C. If it is a stock in trade, then we say 43CA, business asset. If it is a capital asset sold at a price less than stamp duty value, then also we take stamp duty value, but under which section? 50C we adopt in this case. Okay. Next, construction and service contracts, sir. We have ICDS 3. ICDS does not form part of your syllabus. It is at final level, so you can skip that one. Next, sir, NPA accounts. Sir, bank on all the loans, they offer interest on which basis? Accrual basis. Even though interest is not recovered, first accrual basis, bank will write it as income first. But what happened here is the account is declared as NPA, non-performing asset. Then should we write interest now? No need. For NPA accounts, when we have to write the interest? If you write the interest now, okay, we will treat it as income. But you need not write the interest now. Whenever you get that interest and credit it to P&L account, then only we will tax it. You need not offer income on accrual basis. Generally, bank, what is the major income for bank? Interest. That interest generally we tax on accrual basis for banks. But if the account is declared as NPA, not on accrual basis, only when you receive the payment, then you have to treat it as income. That is the thing which has been considered. Next, speculative transaction. In last session itself, we have discussed it, sir. When there is no actual delivery, difference of prices, if I settle, it is called as speculative transaction. So our business may not be only with actual delivery. Just if I do speculative without any investment, without any taking delivery. Today morning I purchase 1000 shares. By evening I will sell it. I will not receive. The difference I will adjust. These types of transactions are called as speculative transactions. So speculative profit is also business profit. But the main thing to be remembered is in speculation, if you get a loss, it can be carry forwarded for 4 years only and should be set off against speculative income only. Speculative loss should only be set off against speculative income only. That is the main thing to be remembered in this case. Okay, next. Section 44, let us begin. Main, this section 44 AA is the important thing. So what is section 44 AA? Maintenance of books of accounts. Sir, whether every SSC should maintain books of accounts. First of all, what do you mean by the term books of accounts? If you see cash book, journal, ledger, all expense bills and income bills. Whether every SC should maintain. Small business SC also should he maintain? Yeah, sir, here it was given clearly that when the SSC is required to maintain the books of accounts. If it is a new business, if turnover likely to exceed, because we don't know whether it will exceed or not until completing the year. That's why here they are saying on which basis, sir? On accrual basis. Here they are saying on which basis? On accrual basis, I mean likely to exceed. What they are saying here is if it is likely to exceed. If it is likely to exceed. In such a case, 10 lakhs if it is likely to exceed. For individual and HUF, it is likely to exceed 25 lakhs. So for companies, 10 lakhs, partnership firm, 10 lakhs. If we estimate that it exceeds, then we have to maintain the books of accounts. Next, the second part, based on profits. Profits likely to exceed 1,20,000. So if turnover is likely to exceed 10 lakhs or profit likely to exceed 1,20,000. For individuals, what is the basic exemption? 2,50,000. That's why for individual or HUF, if you estimate that your profits would likely to exceed 2,50,000, in these cases, what should you do, sir? You have to maintain the books of accounts. existing business, last 3 years, any of the 3 years if your turnover exceeds 10 lakhs or your profits exceed 1 lakh 20. In case of individual and HUF, this limit of 10 lakhs is increased to 25 lakhs. This profit of 1 lakh 20 is increased to 2 lakh 50. So this is in case of business. And coming to second part, in case of profession. In case of profession, here is the professionals list, sir. Lawyer, doctor, chartered accountant, cost accountant, company secretary, film artists, film directors, so story writer. These are all the persons who are the notified professionals. Okay, sir. So what? Yeah. Now coming back to the discussion. All these notified professionals, what can we do is, if it is a new profession, gross receipts here, profit they are not saying, sir. Only if your gross receipts likely to exceed 1 lakh 50, and for existing profession, in last 3 years, all the 3 years, earlier it's any, for business, here we said any, but here, all the 3 years, if your profits likely to exceed 1 lakh 50,000. So in these two cases, you have to maintain the books of accounts. Is it clear? So these are the professionals list. Based on that, they have to maintain the books of account. For how many years should we maintain these books of accounts, sir? For 6 assessment years minimum we have to maintain. Non-maintenance will lead to a penalty of 25,000 rupees. Now here comes the important chart, sir. This chart I will explain with the basis of another chart. Yeah, this I will take as the basis. Sir, generally our business turnover greater than 1 crore, we have to get tax audit. But there is an option for individual HUF and partnership firm that up to 2 crores. If your turnover do not exceed 2 crores, you can opt to show income at the rate 8%. Rather than maintaining books of accounts simply on your turnover, you offer income. How much income should I offer, sir? Simply on the turnover, you offer income at the rate 8%. If you have bank credits, any sum created in the bank account by the customers directly, not cash deposits, sir. If the customers directly transfer to our bank account, then 6% of the turnover has been specified here. Sir, which section we are dealing here? Section 44 AD. Under section 44 AD, 8% of the turnover we have to offer it as income. But if the sum is created to bank account, 6% of the turnover. So total 50 lakhs is created, sir. Out of it 30 lakhs through bank, 20 lakhs cash. Okay. 20 lakhs into 8%, 30 lakhs into 6%. We have to offer it as income. If you offer that income, what is the benefit? No need to maintain books of accounts at all. Sir, that much income I can't show, sir. I will show only 2% or 3%. Then you have to maintain your books of accounts under 44 AA, and you have to conduct audit by a chartered accountant. That means whether you have correctly computed the profit or not, you have to get audited by a chartered accountant. Is it clear, sir? Next, but if turnover is greater than 2 crores, audit is mandatory. Even though you offer 8% or 12%, audit is mandatory. Is the provision clear? Right. So now let us come to the balance points. Just a minute. Yeah. So next, if we consider in case of others like a partnership firm, we have considered in left part itself. Sir, here others means who will be like individual. We have already covered left part itself. So here companies, Cooperative societies will come under this point. Artificial judicial persons will come under this point. All others, if your turnover is less than 1 crore, let me take LLP as example. For LLP, if turnover is below 1 crore, should they offer 8% income? No need. 2% is enough or 3% is enough. But they have to maintain books of accounts. 44 AA mandatory. What has been specified here is 44 AA is mandatory. But what happens if turnover is greater than 1 crore? Then audit is mandatory. If your turnover is greater than 1 crore, then 44 AA, books of accounts maintenance, and AB, get it audited by a chartered accountant. Both were become mandatory in this case. Sir, is this part very clear? So this is a case of business. Either turnover less than 2 crores for individual HUF, you offer income, there no need books of accounts. But if your turnover is greater than 2 crores, no doubt at all, you have to maintain books of accounts. This is a case of business. But for professionals, what they have given here, if you see, if your gross receipts were less than 50 lakhs, you can offer 50% income. If I repeat, if your gross receipts do not exceed how much, sir? 50 lakhs, then how much percentage we have to offer it as income? 50% of your gross receipts you have to offer it as income. How much, sir? 50% of your gross receipts you have to offer it as income. Sir, 50% for profession. Yes, for professionals, expenditure will be low, sir. For business, we have major expenditure purchase. But for profession, there will be no major expenses. That's why they are saying 50%. That means if I get 20 lakhs created in my bank account, if 20 lakhs is created in my bank account, what should I do, sir? 50%. 10 lakhs I have to offer income. 20 lakhs is created in my bank account. 10 lakhs I have to offer income. Sir, if I offer 5 lakhs or 6 lakhs, what happens? Yeah, if you want to offer lower one, then you have to maintain books of accounts under 44 AA and you have to get it audited by a chartered accountant under section 44 AB. So both the things has been specified there. So, sir, I think the provision is very clear to you. What happens if gross receipts greater than 50 lakhs? Then no doubt at all, you have to compulsorily get audited under section 44 AB and maintain books of accounts under section 44 AA. So it was clearly given in this chart when we have to maintain, when you need not maintain. So both the things I have clearly given there itself. So is the provision very clear to you? So by this, both business and profession, both things we have concluded. Sir, 44 ADA for whom professionals only. Professionals list already I have specified in 44 AA. There how much income should we offer, sir? 50% or higher sum. Sir, can I offer 60%? Yes. Even in 44 AD, can I show 15%? Yes. AD. ADA above 50% you can show. There minimum 8%. Here minimum 50%. What happens if I offer this one, sir? All the expenses should be deemed to be allowed. All the expenses shall be deemed to be allowed in this case. Next, 44 AE. This is another presumptive scheme. If SSE is engaged in a goods transport agency, that means transportation business, for them they said that rather than, what is the main income to them, sir? Freight. Rather than maintaining books of accounts, they said that for light good vehicles, you offer per every month 7,500 income. For heavy good vehicles, you offer every month 1,000 per ton. Heavy goods vehicles, they are saying you offer 1,000 per ton. Light good vehicles, they are saying to offer 7,500 per month. Sir, is the difference are you pointing out? So 1,000 per ton. Okay, the vehicle weight we can know in RC book, sir, generally. Gross weight of the vehicle we can know in RC book. So you see that RC book and find out what will be your limit. So based on that, for every ton, how much should we offer as income, sir? 1,000 for every ton we have to offer as income. In case of heavy good vehicle, sir, heavy or light, how can we know? 12,000 kilograms. 12,000 kgs has been specified. The vehicle weight is more than 12,000 kgs, it's heavy. Less than 12,000 kgs, it's light. Next. This is not relevant. Yeah, that's it, sir. The main provisions regarding IPCC we have covered, these journal entries and all. Is a general thing. Sir, here in this PGBP, what we are doing is we begin with net profit as per P&L. So what section 29 is specifying is manner of computation. Generally, we begin with net profit as per P&L. Certain disallowances, some additional allowances, some items created to P&L but were exempted, that we need to take it out. Some were not created to P&L, we need to add deemed incomes. Then we get income from PGBP. Those allowances and disallowances, we had a discussion. So I think all the provisions relating to PGBP, the more core areas we have covered in today's session. So next, we are going to begin with the capital gains head. We are going to begin with the head capital gains. So let us have a small break for 10 minutes. So I will come back at 8:40. We shall begin again the session at 8:40 with the capital gains. The next topic which I am going to take to you is the capital gains, because one question will be compulsory in our examination from this capital gains. One question will compulsorily be asked. So this is the capital gain topic which I am going to start it to you now. So let us take a break for 10 minutes. I will come back at 8:40. So you can stay on at this Zoom. So after 10 minutes, I begin with this capital gain, inclusions, exclusions, exemptions, everything we will have a discussion. This capital gains and other sources. These are the main core areas which we are going to consider today. And tomorrow and day after tomorrow, we focus on GST. Same like this, core elements we are going to have a discussion. Okay. So all of you, just wait for 10 minutes. I will come back at 8:40. Yeah, now let us come back to our discussion. So now we are going to begin with the capital gains. So capital gains, what is the charging section? Section 45. What does the section 45 deal with? The charging section. It has imposed 5 conditions to tax the income under the head capital gains. Number 1, there must be a capital asset. What do you mean by the term capital asset? We are going to learn here. Number 2, it must be transferred. What are the inclusions in transfer and what are the exclusions in transfer? We have to refer. Next, number 3, the transfer must have taken place during the previous year. Number 4, it should result in out of gain. Number 5, it should not be exempt under these sections. So those sections we have to have a focus. So what are the circumstances in which we can claim exemption under those sections? So when it is not admissible, those things we are going to have a special focus now. So here if you see, first we are going to focus on capital asset definition. Any property held by the SC, whether or not for the purpose of the business, any property, any type of property held by SC, whether or not for the purpose of the business, it need not only be used for business, for personal use also, any property. Sir, business asset if we sell, do we want to tax it under the head PGBP only? No need. Block of assets generally if we sell, under which head we tax it? Under the head capital gains only we tax it. Generally if we sell any of the business assets, which is a part of the block, if we are going to sell, then under which head is it taxable? As a short-term capital gain, we are going to tax it. So here, the term capital asset includes even the asset is used for business also. So block of assets income that we arise. So we say the short-term capital gain and short-term capital loss. So property of any kind. And number 2, it may be mutual funds also. Securities held by a foreign institutional investor. When foreign country has investment in India, it's also a capital asset, including right. If a holding company transfers its right to its subsidiary, that right is also called as a capital asset. The capital asset definition excludes stock, because stock in hand, if you are going to sell, it is taxable under the head PGBP, not under capital gain. So it excludes stock, personal effects. Sir, personal furniture, personal bike, if I sell, tell me, sir, generally personal effects, we get a loss or a profit? Loss only. Second hand goods. Sir, I have purchased bike for 1 lakh. Now, if I sell the bike, will I get 1 lakh? No. Very low price, 40, 30,000, very low amount I will get. So in this case, for personal effect, generally we usually incur loss. That losses, they were set off against the taxable incomes, which will lead to tax avoidance. That's why they are saying that personal effects, generally we will get loss only. For all the personal effects, generally we usually get a loss. That's why they are saying that personal effects you ignore. Personal effect is not a capital asset at all. I repeat, they are saying that personal effect is not a capital asset at all. The definition of the term capital asset, we are going to exclude the personal effects. Is it clear? Next. Next thing, rural agricultural land. Sir, which agricultural land they are specifying here? Rural. Urban agricultural land is liable to capital gain. Rural means generally in Telugu we call Paltur. Village. A agricultural land located in the village, if we sell, no capital gain at all. Sir, my grandfather has purchased land for 5 lakhs in 1980. Okay. Now I am selling for 1 crore, sir, agricultural land. Okay. Then also no tax. Rural agriculture, sir, if a building in rural area is sold, it is taxable. A land, which land? Agricultural land located in rural area is not a capital asset. Next, the gold bonds. Generally, bonds, debentures are capital asset. Gold bond is not a capital asset. That's what has been specified here. Next, difference between short-term capital asset and long-term capital asset. Sir, simply speaking, a long-term capital asset means other than short-term. But what is short-term capital asset has been defined here. Short-term capital asset means the thing which has been specified here. If you see, number 1, shares. When can shares be treated as short-term capital asset? If it is a listed share, if it is held for less than 12 months, it is called short-term. And if it is unlisted, held for less than 24 months, it is called as short-term. Sir, is it clear? Shares listed shares 12 months, unlisted shares 24 months has been specified here. Next, coming to securities, listed securities less than 12 months, unlisted securities means nothing but debentures, bonds like that, sir. Okay. Debentures listed less than 12 months, if we sell, it's called short term. After 12 months, if we say sell, it is called long term. Unlisted debentures, 36 months is the holding period specified. Next, mutual funds. For mutual funds are of two types. I said more than 65% of capital if it invested in equity shares, that mutual fund is called as equity oriented fund. That equity oriented fund, how many months were specified here? 12 months. Sir, for debt oriented fund, how many months were specified here? 36 months were specified in case of debt oriented funds. Sir, am I clear with this issue? So finally, what they are specifying here is mutual funds 12 months, debt oriented fund 36 months. Sir, what happens if it is a short term or long term, sir? What happens in this case? If it is a short term or long term, sir, the mode of computation changes. Short term, long term, we claim indexation. Short term, we don't claim indexation. That's why the mode of computation will change for short term and long term. Next, units of UTI. UTI stands for Unit Trust of India. This is the first mutual fund in India actually. In India, the mutual fund actually begin with UTI only. UTI stands for Unit Trust of India. So what they have specified is in case of UTI, less than or equal to 12 months short term, more than 12 months long term. Zero coupon bond also more than 12 months long term, less than 12 months short term. Land or building 24 months is given. Any land more than 24 months, if I hold it's long term, less than 24 months, it's short term. Next, business trust units, not for IPCC, it is for final level. So you can skip regarding business trust. Any other asset, what they have specified is 36 months as the basis. Any other case, what is the basis, sir? 36 months is the basis. More than 36 long term, less than 36 short term. Sir, all the provisions very clear to you. Next, coming to the thing. Short-term capital asset, if it is held for less than or equal to 12 months. So short-term capital asset means if it is held for less than or equal to 12 months. In such a case, same thing, the same charts are 12 months I have categorized into one, 24 months, 36 months. Three parts I have divided, that's it. Sir, exactly if we hold for 36, 12 and 24 months, it's a short term. So exactly on the last day if we sell also short term. Next day if we sell, then only long term. Sir, land I have purchased a year back. Okay. Now I have constructed building and immediately I have sold. So from land point of view, it's long term. From building point of view, it's short term. What should I do? Make separate computation. Based on stamp duty value, you separate land value and building value. So land long term, building short term. Very important, sir. Many times a question has been asked. Property constructed on a land purchased earlier. In case a land is held by SC for more than 24 months, but the building constructed over it is held for not more than 24 months, there will be long-term capital gain on sale of land and short-term capital gain on sale of building. Is it clear, sir? Next thing. Mode of computing capital gains. So how to compute capital gain? Left side short-term capital gain, right side long-term capital gain. How we are going to compute this capital gain, sir? Sir, main difference is indexation. Long term we claim indexation, short term we don't claim indexation. And next main thing is exemption. So this is the first major difference, sir. This is the major difference, first one. And this is the second major difference. So main only these two differences existed. So number one here, indexation, here no indexation, here all exemptions. Long-term capital gain, we can claim all exemptions, but short-term capital gain, only 3 exemptions are specified here. Okay. So now let us begin our discussion. So these are the index numbers. In your examination, this is the index number. Whether you need to remember, no need. Just for reference, I have given. In exam itself, they will specify the index number. Okay. Next. Next heading is cost of acquisition. Sir, cost of acquisition is nothing but our purchase price. If the asset is acquired before 1/4/2001, index numbers have been started from 2001 to. That's why they have specified that whenever you have purchased an asset before 1/4/2001, the fair market value on 1/4/2001 or actual cost, whichever is higher, has to be considered. Sir, higher or lower, whichever is higher has to be considered. The fair market value on 1/4/2001 or actual cost, whichever is higher. So what happens if the cost of asset acquired on or after 1/4/2001? Then cost of acquisition is equal to actual cost only. So if we purchase after 2001, we consider actual cost. If we purchase before 1/4/2001, the fair market value on 1/4/2001 or actual cost. Tell me, sir, whichever is higher or lower? Whichever is higher has been considered. That means if I have purchased in 1980 for 5 lakhs and 2001 its value is 15 lakhs, which we should consider? 15 lakhs only we have to consider, whichever is higher. Because from that year only the indexation benefit is available to us. That's why they have considered like that. So I think that point is very clear to you. So now if we continue our discussion, cost of improvement. Sir, here we have taken fair market value on 1/4/2001 means all the improvements were also covered here. That's why improvement before 1/4/2001 is taken 0. On or after 1/4/2001, it's actual cost. On or after 1/4/2001, its actual cost. Before it has been considered as 0. Sir, is the provision clear to you? Next, if we continue, transfer definition. So here we have both inclusions and also exclusions. First, if we discuss inclusions, sale, exchange. Sir, even relinquish, I leave my title, extinguishment of any right. Right shares I got a issue. But what I am saying is I don't want right shares. Can I renounce it to another person? Yes, that renouncement itself is liable to tax. Okay. Next, even I don't sell, government compulsory acquires my property is also liable. So conversion of capital asset, sir, these all elements, sir. Now we will have a discussion detail. All these elements, I have converted it into 18 special cases. If we learn these 18 special cases on capital gain, any question you can answer. I have converted all the important points into 18 special cases. So all of you just have a focus on these 18 special cases. Automatically in exam, you can easily answer. So the first thing is conversion of a capital asset into stock in trade. What is the first thing, sir? If we convert the capital asset into stock in trade, what is the meaning of this provision? Sir, first it's my asset. In 2005, I have purchased it. It is my asset. Okay. Later, what I have done is, since there is a demand to my building, now I have converted it into stock in trade and I am selling the building in the open market. So the title is conversion of a capital asset into stock in trade. In such a case, sir, conversion shall be regarded as transfer. As per transfer definition, whenever you are converting, it should be regarded as transfer. That's why the fair market value, what the thing has been considered here is the fair market value on the date of conversion will be regarded as the full value of consideration. Sir, what the thing has been given there, sir? The fair market value on the date of conversion, okay, shall be regarded as the, for example, on 2001, I have purchased for 5 lakhs. Now the fair market value is 20 lakhs. Now I have converted. The 20 lakhs will be taken as the full value of consideration. Even though I am not realizing the currency, I am not realizing any money, the fair market value on the date of conversion itself is the full value of consideration. So this chart is very useful to you. Wherever there is a term called the special case, 18 the special cases, what are the important terms which we need to remember? I have presented like this in a table. This is the format of our computation generally. Full value minus expenses, net consideration, cost of acquisition. This is our general format. In this format, which are the things which we need to remember I have given here. Sir, conversion amounts to transfer, but tax should not be paid immediately. Sir, when should we pay tax? Tax shall be payable at the time of sale only. Sir, I didn't understand. 2005 I have purchased, sir. 2015 I have converted. 2020 I am selling. When should I pay capital gain tax? 2020. But I need to compute indexation benefit up to 2015 only. In 2015 it's transfer, but taxability shall arise in the year of sale. Sir, what I am specifying here is computation you make in the year of transfer, but tax you have to pay when that converted stock in trade has been sold. Because when I will get cash after sale only, then you have to wait until you have realized the cash. After you realize the cash, then you can sell it. So this is conversion of a capital asset into stock in trade. Sir, is this clear? Right. Sir, here indexation shall be made up to the year of conversion. Even though taxability shall arise in 2020 in my case, indexation benefit will be available only up to the year of conversion only. Okay, right. So next, here business income is sale value of the stock minus fair market value of assets at the time of conversion. Sale value of the stock minus fair market value. Sir, at the time of 2015, the fair market value is 15 lakhs. 15 lakhs is the full value of consideration for computing capital gain. Now, if I am selling for 20 lakhs, 20 minus 15, that 5 lakhs is considered as the business income. Because now what I am selling, stock in trade, the sale value is business income. Next. Sir, if partner brings any asset to the firm, what is the journal entry we write? Asset account data to capital account we write. If partner invests cash, we say cash account data to partner's capital. But if partner invests any asset, we have to say asset account data to capital account. Earlier, who is possessing this asset? Partner. Now, who is possessing this asset? Partnership firm. Whenever we are transferring the asset from partner to partnership firm, whenever we are transferring the asset from partner to firm, it shall be regarded as transfer. Because earlier partner is the owner, but now who is the owner? Firm is the owner. That's why we are saying it shall be regarded as transfer, even though he didn't receive any cash. Who didn't receive cash? Partner. Even though he has not received any cash, he is liable to pay taxes. How much should he pay, sir? That's what we are specifying here. That's what we are specifying here. The amount recorded in the books of the partnership firm. The amount recorded in the books of the partnership firm. Because we are not getting any cash. But fair market value should not consider. The amount in the books of the firm, that we need to consider here as the income. Remaining all aspects one and the same. Next, third special case is, sir, these 18 special cases and exemptions we will discuss. And then we will go to other sources. By that, the core elements of income tax will be completed. Tomorrow we focus on GST. Here if you see, third point, transfer of asset by partnership firm to partner. Sir, here who is transferring? Partnership firm. To whom are they transferring? To the partner. Transfer of asset by partnership firm to the partner. In this case, the fair market value of the asset on the date of transfer shall be regarded as the full value of consideration. The fair market value of the asset on the date of transfer shall be treated as the full value of consideration in this case. Okay. Earlier we have considered amount recorded in the books of the partnership firm, but not like that now. Now directly what we are considering is the fair market value of the asset shall be regarded as the full value of consideration. Because here partner will not maintain books of accounts. That's why here firm will maintain books of accounts. That's why we said amount recorded. But here partner will not maintain. That's why we are saying fair market value. Next, special case number 4. So total how many special cases? 18. Yes, we have completed 3. Now coming to special case number 4. Compulsory acquisition under any law. Sir, what's the title? Compulsory acquisition under any law. Sir, what is that compulsory acquisition? We are selling the property. Then capital gain arises. Everyone is ready to pay. But now we are not selling the property. Now we are not selling the property. Then why should we pay taxes, sir? Even we are not selling, if government acquires our property and pays us compensation, that shall also be regarded as a transfer. Not only we sell, even government compulsorily acquires our property, it should also be regarded as transfer. That's what the thing which has been specified here. Generally, if I sell, it shall be regarded as transfer. But even though I didn't sell, but government acquires my property under compulsory acquisition and they pay me any compensation, it shall also be regarded as transfer. Whatever the compensation government gives, it has to be regarded as the full value of consideration. But taxability, government has compulsory acquired on 2018 and they are paying compensation on 2020, sir. When should I pay tax? On 2020 only. That means taxability when it will arise in the year in which we have received the compensation. Here if you see, a taxability arises in the year in which we have first received the compensation. When you have received the compensation, then only taxability arises. Sir, is this clear? So if you come back, the compensation shall be determined by the government, but indexation up to the year of acquisition. Even though in my example, in 2020 you are liable to tax, but indexation benefit will be given up to acquisition date, up to 2018 only. Next, if the compensation is not sufficient and we have went to a case, what is this one, sir? Enhanced compensation. What is that? Enhanced compensation. In case of enhanced compensation, so what they are specifying here is, I have asked, government has paid me 10 lakhs compensation, but we have went to court and they have decided that, so you have to get 25 lakhs compensation. Okay, how much extra I am getting now? 15 lakhs. That 15 lakhs after final order has been passed. What was given here, sir? After the final order has been passed, then you consider it as the income. When we need to consider it as the income? After the final order has been passed, has been given here. Not interim order, sir. The final order has to be passed. Sir, initial compensation is taxable in the year of receipt. Initial compensation we will tax in the year of receipt. But this is not initial compensation, sir. This shall be taxable when after the final order has been passed. This is enhanced compensation. Okay. So next thing is a slump sale. Sir, when the slump sale will be taxable, what do you mean by the term slump sale? Sir, when the entire business is transferred, when entire business is transferred, it is called slump sale, like amalgamation demerger. Can I say amalgamation demerger as slump sale? Yes. Here entire business will be transferred. In that case, what they are specifying is the lump sum amount, amalgamation or demerger consideration they will fix. No, sir. That consideration shall be regarded as the full value of consideration. So the lump sum amount which we are receiving here can be treated as the full value of consideration. Minus, earlier we write here cost of the asset, but now we write net worth. Sir, in accounts, this difference you say goodwill or capitalism. Lump sum consideration minus net worth. What we will say? In accounts, we say this difference as, yeah, capital gain, capital reserve or goodwill in accounts. But here, the difference we say as capital gain. Sir, how to compute this net worth? Total assets minus outside liabilities. The total assets, depreciable assets, not book value, sir. WDV as per Income Tax Act, you have to take. I repeat, WDV as per Income Tax Act. 35AD, specified business, if you remember, 100% deduction you have already claimed. That's why that value is 0. All other assets, book value. Which value we are considering, sir? Book value. Liabilities also book value. All other assets and also liabilities, both we take book value. Next. So here no benefit of indexation. Then the gain is short or long, sir. If it is the company is formed more than 36 months, it's long term. If it is less than 36 months, it's short term. Don't think that since there is no indexation, always short term only. That's what the thing which we need to consider here. Lump sum amount minus the net worth. Lump sum amount minus the net worth we need to consider in this case. Is the provision clear? Next. So total how many special cases? 18. out of which we have completed 6. Coming to 7th special case, liquidation of companies. Sir, what do you mean by the term liquidation? The company is closing. Sir, the company is closing means shareholders will give back their shares and they will receive assets or cash, whatever mean. Upon liquidation of companies, the shareholder will surrender his share. So who is the transferor here? Shareholder. The transferor is the shareholder who will transfer his shares and receive assets. So the shareholder is the transferor in this case. So what the shareholder is required to do is, upon his transfer, what the fair market value he is receiving, we need to see here. If company pays him any assets, it's fair market value. If company pays cash, that cash will be regarded as the full value of consideration. Is it clear, sir? But there will be some deemed dividend to the extent of accumulated profit under 222C, and company will be liable to pay dividend distribution tax on certain amount. That you need to reduce. That dividend distribution tax on which dividend distribution tax is levied, that you need to reduce. On balance amount only we are going to consider here. Okay. So next, expenses we reduce, then we get net consideration minus cost of acquisition or indexed cost of acquisition, cost of improvement or indexed cost of improvement. Which one we need to consider here, sir? Shares value we need to consider. I repeat, which value you need to consider? Shares value, because here the shareholder is transferring his shares. Okay. So next, sir, if my asset is damaged or destructed, fire accident, but it is injured. If it is not injured, total loss. If there is insurance, in such a case, the insurance compensation received will be regarded as the full value of consideration. Whatever we receive the insurance compensation, that insurance compensation which we are going to receive shall be regarded as the full value of consideration in this case. And remaining cost of acquisition or indexation, depreciable assets, directly we take WDB. Non-depreciable assets, what we will take? Indexation benefit we take. Mode of computation is same, but if the asset is damaged due to insurance, damage due to any destruction or damage, then the insurance compensation that we receive is also taxable. That's the thing which I am specifying. Any asset damage due to flood, tufan, hurricane, cyclone, whatever may be, all the things has been considered here. Next thing, buyback of shares. Buyback means, what do you mean by the term buyback generally? Company is purchasing back its own shares. If company purchases back its own shares, so it is called as a buyback. If company purchases its own shares, it is called as buyback. Why the company is purchasing its own shares, sir? Earlier, due to lack of capital, they have issued, sir. But now there are more profits. Now they are trying to reduce the capital. That's why company is buying back its own shares, which is called as buyback of shares. In case of buyback of shares, the buyback price which has been fixed, company will pay some compensation or consideration. That buyback price will be taken as the full value of consideration. Minus expenses, cost of acquisition of shares is one and the same. But with effect from 5/7/2019, this thing you need to remember, sir, for example. With effect from 5/7/2019, what they have specified is, if listed or unlisted, whoever company buybacks, company only will pay tax. How much tax? 20% tax, 12% surcharge, 4% health and education cess. From this 5/7/2019 onwards, if company is going to make buyback of shares, now who is going to pay the taxes, sir? Company itself will pay the taxes. Now, if company makes a buyback from 5/7/2019 onwards, if company makes buyback, then the company is required to pay the taxes. So that's why what we are specifying in this case is it is exempt in the hands of shareholders. But this is from which date, sir? 5/7/2019. Before that, if listed company buyback, shareholder should pay tax. Unlisted company buybacks, company only will pay tax. So that is a case for buyback. So now buyback we need not bother, because now who will pay taxes, sir? Now on buyback, who will pay taxes? So now on buyback, only the company is going to pay the taxes. It may be listed company or unlisted company. Now only company is going to pay the taxes. Sir, is the provision very clear to you? Yeah. So now let us continue our discussion. So next thing is special case number 10, right shares. Sir, what do you mean by the term right shares? Sir, right shares means issued to existing shareholders. Issued to whom, sir? Existing shareholders is called as right shares. Sir, what happens if I subscribe? If you subscribe in right shares, okay. Whatever you are getting subscription amount, that shall be regarded as a cost of acquisition. Okay, that shall be regarded as cost of acquisition. So next, coming to the other thing, but if I renounce, I got right to purchase right shares, sir. But what I am doing is I am not accepting. I have given that right to another person. That is called as renouncement. For 10 rupees, I have got an offer from company to purchase for 20 rupees per share. But I have renounced to other person for 5 rupees per share. Then in this case, what should we do? Upon renouncement, it is called as extinguishment of right. That renouncement amount will be taxable to you under the head capital gains. Here if you see first part, in the hands of renouncer, amount received for extinguishing a right is a transfer. So second part, in the hands of whom, sir? Renouncee. In the hands of renouncee, what should we do? The amount paid to the company plus amount paid to the renouncer. It shall be cost of acquisition for him. Because he is paying 5 rupees to me, 20 rupees to company. 25 rupees will be cost of acquisition to him. Is this clear? Next part, bonus shares. What is the next thing, sir? Bonus shares. Sir, in case of bonus shares, if the bonus shares were allotted before 1/4/2001 or on or after 1/4/2001, the bonus shares which were allotted before 1/4/2001, what they have considered here is 0. On or after 1/4/2001, cost of acquisition is 0. Okay, sir. On or after 1/4/2001, the cost of acquisition is 0. But before 1/4/2001, what we have considered here is the cost of acquisition is equal to the fair market value on 1/4/2001. So this was regarding bonus shares. Next, coming to the other thing, intangible assets. Sir, intangible assets, if you purchase, that purchase price will be cost of acquisition, or else self-generated goodwill 0. Self-generated assets, here if you see self-generated 0. Only if you have purchased, then that purchase price we need to consider. So total 18 special cases, we have completed 12 cases. Now let us enter into 13th case. What's the title, sir? Advance money forfeited. Advance money forfeited. What is the meaning of this term, sir? Sir, I have purchased an asset for 5 lakhs. Later I thought to sell and I have received advance 50,000. But since the customer has not given me balance amount, I have forfeited the contract. I have taken advance money for sell, but later since he didn't give me the balance, what I have done is I have forfeited. That means I have cancelled the advance. Is it benefit to me? Yes, I didn't sell the asset and the deposit is with me. It is the benefit to me. So what we need to do in this case, sir? So in case the advance money is forfeited, what the thing they have considered here is on or after 1/4/2014, entire advance money forfeited will now be taxable under the head income from other sources. Which head, sir? Under income from other sources, we are going to tax it. Before 1/4/2014, we reduce from the cost of acquisition and then claim indexation. I repeat, earlier, before 1/4/2014, if advance money is forfeited, we have to reduce from the cost of acquisition. On or 1/4/2014, if advance money is forfeited, then what should we do is directly we have to tax it under the head income from other sources. Okay. Next, this income declaration scheme is for final level, sir. You need not remember this scheme. Next, sweat equity shares. Very simple example I have given, sir. Sweat equity shares are issued for 150, but on that date, fair market value is 200. Sir, will sweat equity shares will be issued at discount? Yes. Lower than fair market value, it will be issued. That's why we call it as sweat equity shares. So 200 value of shares is given to employee just for 150. Sir, for whom is it benefit? For employee. That difference 50 is taxable under the head salary perquisite in the hands of employee. Later, if that employee has sold it for 230, he has purchased for 150, but up to 200 he has paid tax by offering income under the head salaries. That's why this difference 30 will be treated as capital gain in future. Not 230 minus 250. 230 minus 200 we need to consider. That's what the thing which has been specified in this special case. Next, land development agreement is another special case. So please listen for a few minutes. Development means there is a land. I need to construct means it takes a lot of time. So what I have done is I have given my land to a developer. He develops 20 flats on my land, gives me 8 flats, he takes 12 flats. What is the benefit to me? Without 1 rupee of investment, without 1 rupee of construction cost, I am receiving 8 flats constructed. What is the benefit to him? To the builder, the benefit is without purchasing land, he is getting 12 flats ownership. But 20 flats construction cost he has to incur. This is the land development where builder will get some flats, owner will get some flats. Sir, owner initially has land. Now he is getting 8 buildings. This is called exchange. That exchange is transfer. But when we need to pay taxes is after completing building construction. So what I am saying is this development is called exchange of asset. Exchange of asset will be liable to capital gain. Exchange of asset will be liable to capital gain. But to what extent, sir? To what extent it will be liable to capital gain means we are going to consider till the completion date. We are going to wait. We are going to wait till the construction is completed. After completing the construction, then we are going to treat the fair market value of the 8 flats as full value of consideration. Then we reduce land value. Those things we will consider, sir. This is a case of development right. Next, APCRDA. Sir, now in 2014, APCRDA Act has been constituted. In which year, sir? In 2014, they have started APCRDA Act, where they have specified that any acquisition made to develop this capital city, you need not pay any taxes. Any acquisition made to develop this capital city, you need not pay any taxes, they have announced. For which exemption is also given under Income Tax Act. So under section 10 subsection 37A, they said that under APCRDA Act, any acquisitions were made is exempted. Under which section, sir? 10 subsection 37A. Generally, they are saying we acquire here and we will allot a plot to you at another place. That also will be exempted. All the cases were exempted. Exchange is exempted. Any compensation given is exempted. Any bonds given is exempted. Everything has been considered. Last, depreciable assets. Sir, depreciable assets always which we need to consider, sir? Depreciable assets we need to consider short-term capital gain or loss. Entire assets in the block, if they were sold, then it amounts to short-term capital loss. Part of the assets, if they were sold, then it does not amount to loss. We have to claim depreciation. Only when the entire block is empty and we get consideration less than the block value, then we have to recognize short-term capital loss. When we get more than the block value, then we need to recognize short-term capital gain. Is it clear? So this was regarding capital gains. Next, section 54 exemptions, let us discuss and then go for other sources. Sir, section 54, we have 8 exemptions to discuss. Let us begin. First, section 54. Which asset I should sell? I have to sell residential house. Which asset should I purchase? Which asset should I purchase? Residential house. I have to sell residential house and purchase. This is 6th point, new asset. New asset, which one, sir? Yeah, if you see, I can construct two residential houses or purchase two residential houses. Construction has to be completed within 2 years. Purchase has to be completed within 2 years. Construction 3 years time. Purchase 1 year before or 2 years after. Okay. But if the capital gain exceeds 2 crores, only one residential house exemption is given. Sir, I repeat, this is the important amendment for your examination. Section 54, what I need to sell? Residential house. What I need to purchase? Another house. I need to purchase another house. But where that house is to be situated? Where that house has to be situated means at your wish. At any place, you can purchase the house. But what has been specified in this case is, can I purchase two houses? Yes, you can purchase two houses. But the thing that has been considered here is, if your capital gain does not exceed 2 crores, I repeat, your capital gain, if it exceeds 2 crores, then no issue. If your capital gain exceeds 2 crores, you have to pay. Only for one house only you have exemption when your capital gain is more than 2 crores. But if your capital gain does not exceed 2 crores, in such case, what they have specified here is, for two houses, you can claim exemption. You can construct within 3 years, or you can purchase 1 year before or 2 years after. So both the things have been considered here. Sir, is the provision very clear to you? Yeah. Now coming to the next thing. But this two houses option is for one time, sir. Again and again, you are not going to get this option. This option only once in your lifetime. Sir, later what happens? One house you can sell, another house you can purchase. That 54 exemption you can claim. You sell one house and purchase another house, that benefit you can claim. This thing has been specified here only when you can purchase two houses. Earlier for one house only benefit is given under section 54. But now the benefit is given for two houses. But that option is only once in your lifetime when the capital gain do not exceed 2 crores. Is it clear, sir? Right. So let us come back. Sir, 54 exemption, when it will be available? Which assets I have to sell? I have to sell residential house. Which asset I have to purchase? Another residential house. So this is which section, sir? 54. Next section, 54B. What I need to sell? Agricultural land. Sir, if I sell rural agricultural land, it is not a capital asset at all. No capital gain. Then what I need to sell, sir? Urban agricultural land if I sell. And purchase another agricultural land. This may be urban or rural, whatever may be. I am selling urban agricultural land and I am purchasing any agricultural land. Then I can claim exemption under section 54B. 54, I have to sell residential house and I have to purchase residential house. 54B, I have to sell agricultural land and I have to purchase another agricultural land. Next, 54D. Now I am not selling, government only compulsorily acquiring. Sir, whether all the compulsory acquisitions exempt? No. APCRDA Act compulsory acquisitions were only exempt. So remaining any compulsory acquisitions were done. What should we do in that case? So all other remaining compulsory acquisitions are that were taxable. Here, since the government has acquired our land and building, again if you purchase land and building, you can claim exemption. That is section 54D. Next, 54EC. Long-term capital asset being land or building or both has been sold. If you sell land or building and you get long-term capital gain, up to 50 lakhs, you can take exemption under 54EC, but you have to invest in NHAI bonds, National Highway Authority of India bonds, RECL, Rural Electricity Corporation Limited, Power Finance Corporation Limited, or Indian Railway Finance Corporation. They are going to issue bonds, sir. In that bonds, if you invest within how many years? Within 6 months from the date of transfer, you have to invest. I repeat, within 6 months from the date of transfer, you have to invest. What happens if I didn't invest within 6 months? In such a case, you cannot claim this exemption. This exemption is available only in a case. This exemption is available only in a case where this exemption is available only in a case where you invest within how many months, sir? Within 6 months you have to invest. Okay. How much extent I can claim? 50 lakhs if you invest in these bonds. And these bonds for 5 years you should not withdraw. What happens if I withdraw within 5 years, sir? Then exempted capital gain will be taxable now. Earlier, whatever you have claimed exemption, that will be taxable now. Okay. So next, coming to the other issues. Next, section 54E, same thing. Here we are investing in this form. Here, if you get capital gain on sale of land or building and invest in mutual funds, then also you can claim exemption. Here also the same 50 lakhs limit has been given. In both the cases, 50 lakhs is only considered. Sir, is it clear? Coming to the next thing. 54F. Sir, what is section 54F? Any asset, for example, gold, can I sell? Yes. If you sell the gold and purchase a residential house, every person should own a house. That is the intention of 54F. Sir, if I sell house and purchase house, which section? 54 section. But it's in this 54F, what I am selling is residential house. Other than residential house. What I am purchasing is residential house. If you invest entire net consideration, not capital gain, sir. Up to here, what we have learned is we have to invest capital gain to get exemption. But in 54F, what we need to invest, sir? Net consideration. If you invest, their entire capital gain will be exempted. For example, if I have sold for 10 lakhs, selling expenses 1 lakh, then net consideration will be 9 lakhs. If you invest entire 9 lakhs, then entire capital gain will be exempted. Sir, what happens if I have invested only 5 lakhs? Proportionate. 5 lakhs by 9 lakhs into capital gains. Proportionate exemption will come. Sir, new house, I have to purchase construction within 3 years or purchase within 2 years or 1 year before. Is it clear? This is 54F. 54G. If I am selling my plant and machinery in urban area, industry in urban area, and purchasing in a village or sedge GA, in village if I invest 54G. Sir, what I am selling? I repeat, if we are selling plant and machinery or land and building located in which area? Urban area. Here, any area. But I am investing in non-urban area. Here I am investing in sedge. Capital gain investment is enough. It may be short because plant and machinery used in industry means it's a depreciable asset. For depreciable asset, we get short-term capital gain. So that you invest, we can claim exemption. Okay. Next, 54GB, let us have a discussion. This is one big exemption, sir. By this, exemptions will be completed. 54GB. What I need to sell, sir? Residential house you sell and proceeds to invest in a new company whose turnover did not exceed 25 crores and that company should be involved in manufacturing technical products. Sir, what I need to sell? I repeat, you sell residential house or plot, land, and the net consideration same as 54F. Total net consideration, not capital gain, sir. Up to now, what we have learned is capital gain. But for 54F and 54GB, what we need to invest is net consideration. If you invest entire net consideration in, where should I have to invest entire net consideration, sir? If you invest entire net consideration in purchasing shares of a company, which company? Technological manufacturing company, whose turnover will not exceed 25 crores. In such a case, I can claim this exemption. But one thing to be remembered is in that company, my capital should be more than 25%. This is another amendment. Earlier, they said that 51% should be my capital. Now it was reduced to 25%, sir. 25% capital is enough. Is it clear? Earlier, how much it would be, sir? Earlier, that is very high, sir. 51%. But now 25% capital if I invest, so it's enough. In that company, my shares should be 25%. That is the meaning of that 25%. Okay. So if I invest in them, then which exemption will I get? 54 GB. Those shares I should not sell it for. There is a lock-in period which was specified here. Those shares which I am purchasing, so I should not sell for 5 years. 5 years is the lock-in period which has been specified in this case. Sir, if you invest entire capital gain, you will get entire exemption. If you invest partly, then part of the exemption only you will get. Is this provision clear, sir? So this was regarding which chapter? Capital gains. All the core concepts we have discussed. Now the balance half an hour, let us go into other sources, sir. So balance half an hour, let us concentrate on other sources and close it. Yeah, now coming to the chapter other sources. All the dividends were taxable under the head other sources. Sir, even though shares I am holding as stock in trade also, any dividend received taxable under head other sources. Sir, dividends were exempt, no sir. Since the company is paying dividend distribution tax, generally the dividends were exempted. But to what extent exemption can be claimed? Only up to 10 lakhs. Any dividend received over and above 10 lakhs, it is taxable under the head income from other sources. And on that, special tax rate of 10% will also be levied. Sir, is this clear? So what I am specifying there is, so in case of dividends, how much above if we receive, sir? About 10 lakhs if I receive the dividend, we are going to tax it under the head income from other sources. That is the first thing. Now coming to the second thing, all the casual incomes. Sir, what do you mean by the term casual incomes? Like winning from lotteries, crossword puzzles, any TV contest if we receive. These are called as casual incomes. Those casual incomes, sir, whether tax will be levied. Yes, 30% straight away tax on casual incomes if you remember. What is the tax rate on casual incomes, sir? Straight away 30% tax would be levied on the casual incomes. So finally, what they are specifying here is in case of casual incomes, I repeat, in case of casual incomes, they are saying that you have to tax it under the head other sources only. Okay. So next thing, employees contribution received by employer. If we consider under head PGBP, it's okay. If we didn't consider under PGBP, we have to tax it under head other sources. So our employees contribution, what is the time? Within the due date of relevant tax. You remember, sir, within the due date of relevant tax, we have to pay employees contribution. If I didn't pay, then you should have to offer it as PGBP income. Even if you forgot to offer under the head PGBP, at least in other sources you have to offer. At least in other sources you have to offer. Okay. Next thing, interest on securities. That means debentures and bonds interest. We have to tax it under the head other sources. Next, plant and machinery and furniture. If I am letting out, which is not my main business. Pandal and Shamyana, if you take, their business itself is letting out of plant, machinery and furniture. For them, fully taxable under the head PGBP. But if it is not my business, then I have to pay tax under the head other sources. If it is not taxed under the head PGBP, then we tax it under the head other sources. Sir, is this clear? Coming to the next thing. Higher income of plant and machinery along with building. This I have discussed in house property, sir. Composite rent. Composite rent, building rent and other facilities and separable. Separately we have to tax it. If it is inseparable, entire thing is taxable under the head other sources. Okay. Next, keyman insurance. Yesterday I have discussed. Sir, maturity of keyman insurance policy received by employee, then salary head it is taxable. Profit in lieu of salary. If it is received by employer, then under PGBP it is taxable. If it is received by family members of employee, then in such a case it is taxable under the head other sources. So this is the conclusion. Okay. So next thing, this point is for final level, you can skip it. Next, interest on compensation. Sir, compensation and enhanced compensation we have discussed in which one? Other sources. Sorry, capital gains. Compensation and enhanced compensation we have discussed in capital gains. But that compensation, if I am receiving belatedly, I will get interest, which is called as interest on enhanced compensation. That interest on enhanced compensation shall be taxable in the year in which it is received. Whenever we receive, then we have to tax that enhanced compensation interest. The year in which it is received. But there is a standard deduction of 50%, sir. Interest on enhanced compensation, there is a standard deduction of 50%. Okay. Next, advance money forfeited. In last topic only we have discussed it. Any advance money forfeited, sir, do you remember? With effect from 1/4/2014, what we should do? Advance money forfeited. 1/4/2014 onwards under the head. 1/4/2014 onwards under the head. Other sources we need to tax. Before 1/4/2014, what we have done? Before 1/4/2014, we have reduced it from cost of acquisition. On or after 1/4/2014, we have to directly tax it under the head other sources. Next, last and final provision, gift provisions. Let us have a discussion on this gift provisions, because in other sources for your examination, only based on this topic only, they are mostly asking the question. So let us come to this gift provisions. Sir, let us concentrate in a detailed manner regarding this gift provision, sir. Cash gift, total year. Sir, one thing to remember, gift from relatives is not taxable at all. Gift from relatives, section 56. You can see this is a relative definition. Father, mother, daughter, son, spouse, brother, father's brother and sister, mother's brother and sister, individuals, brother and sister, spouse, brother and sister, all the brother and sister of father, mother, individual, spouse. So these are all relatives. Linear ascendants, grandfathers, grandmothers. Linear descendants, grandsons, granddaughters. All these persons, if we receive any gift, it is not taxable at all. Gift from relatives is not taxable at all. Sir, what happens if gift is received from non-relatives? Yeah, now we are coming. Gift received from non-related persons, sir. If it exceeds 50,000, what has been given here, if it exceeds 50,000, then we are going to tax it. Where the aggregate receipts received during the year exceeds 50,000, then the entire cash receipts would be taxable. Sir, is it clear? So next thing. Here the limit of 50,000 should be applied for her. Now, mobile properties. Any mobile property which receive gift. Sir, mobile means whether car, laptop, mobile, can I consider? No. Here there is a property definition, sir. Except this immobile property, you keep it out. It's an immobile. Shares, jewelry, archaeological collections, bullion, drawings, paintings. Only these items. If I give car as gift, nothing is taxable. Only this property definition items is given as gift. Then in such case, if the fair market value of the gift is less than 50,000, nothing is taxable. Only if the fair market value exceeds 50,000, then only the taxability arises. Only if the fair market value exceeds 50,000, then only the taxability will arise. Is it clear? Sir, if it is for inadequate consideration, 1 lakh value of jewelry they have given for 25,000 rupees only, sir. Here, this difference of 75,000 is called as inadequate consideration. The difference, if it exceeds 50,000, then we are going to tax the difference. Okay, inadequate consideration, we have to check difference. Without consideration, aggregate fair market value we need to check. Next, same, sir, here aggregate of all the immobile properties we have to consider. Aggregate. Whereas for immobile property, each property stamp duty value. Sir, one land I have received 40,000 value, no tax. Another land I have received 40,000 value, no tax, not aggregate. For mobile properties, we have to make aggregates. But for immobile properties, we should not consider aggregate. Each property stamp duty value you need to consider. So Immobile properties without consideration, what they have specified in this case is, if you receive without consideration, each property value should exceed 50. Inadequate consideration, difference should exceed 5% also. If you receive, if you remember, 5% variation is permissible, I have said to you. So difference should exceed 5% also. Two things to be remembered. Difference should exceed 5%. That is the first condition. Condition number two, 50,000 rupees also. Difference should exceed 50,000 rupees and also 5%. Then only we are going to tax it under the head income from other sources. Sir, here for each category 50,000, sir. I have received cash gift 40,000, mobile 40,000, immobile 40,000. Then what should we do? No tax at all. Here 1, 2, 3, 4, 5. For each of the above categories, you have to impose this limit. For each category, you need to consider. Sir, what happens if gift is received from employer? Sir, if employer gives you gift, cash gift fully taxable, gift in kind, in salary head we have discussed, above 5,000. If the gift amount exceeds 5,000, then only it is taxable. Is it clear, sir? That is gift from employer. Yeah. So by this we have completed this gift provisions also. So next, one more important point let me discuss to you. This dividend stripping is important, sir. For IPCC level, let us discuss this concept of dividend stripping and close the session. Sir, dividend stripping means, do you remember cum dividend and ex dividend? Cum dividend means the purchase price includes dividend also. But I am selling at ex dividend. That means the purchase price has excluded, sale price has excluded dividend. If you observe here in this case, on 23/9/2019, we have purchased 1,000 shares at the rate 150 per share for 1,50,000. On record date, that is dividend, company paid 20 per share. That means this 1,000 per share is cum dividend. So from record date, within 3 months, if I purchase in this gap if I have purchased and I have sold within 3 months for 100 per share, 1 lakh. Generally what I say, 1 lakh minus 1,50,000, 50,000 is my loss. But you should not say this is ex dividend, after dividend. This is before dividend, cum dividend. So any shares purchased within 3 months from record date and sold within 3 months from record date, in such a case, out of the loss, the dividend received should be excluded. That is called as dividend stripping. Very important provision. From record date within 3 months I have purchased, and after purchase, if it is mutual fund units, 9 months if I have sold within 9 months. Other units if I have sold within 3 months. In such case, what they have specified here is, any loss, if you get gain, no issue, sir. If you get gain, then no issue. But if you got loss, out of that loss, the dividend which we have received earlier has to be reduced. Because this is ex dividend, this is cum dividend. That's why they are saying to reduce the dividend. Okay. So this was the concept regarding which topic, sir? Regarding dividend stripping. Okay. So one more thing I would like to clarify on dividend concept, and then I will close the issue. Sir, dividend, yeah. If you see, taxability of dividend in the hands of shareholders. Sir, shareholders, please see this point. This point is important. Aggregate dividend less than 10 lakhs. Exceeds 10 lakhs means up to 10 lakhs you can claim 1034 exemption. Greater than 10 lakhs, you are liable to pay special tax rate at the rate 10%. Sir, if it does not exceed 10 lakhs, fully exempted. But if dividend has exceeded 10 lakhs, then we need to offer income. On that excess of 10 lakhs, whatever we are receiving, we have to pay special tax rate at the rate 10%. Under which section, sir? Under 115 B, B, D, A. Up to 10 lakhs, it is exempted. Okay. And on dividend, the company is liable to pay which tax? Dividend distribution tax. Dividend distribution tax not only on normal dividend, it will also be levied on deemed dividend also. Deemed dividend issues, we can go through it. Deemed dividend, if you see, if company distributes assets instead of dividend, if company distributes assets, it's also dividend distribution only. Instead of giving cash, if company issues debentures, it's also deemed dividend. Upon liquidation, all the surplus will be given to shareholders. It will also be treated as deemed dividend. Next, if company reduces share capital from 10 each to they are reducing to 5 each and they are giving back to the shareholder. Not buyback, sir. Buyback means all the shares they are purchasing. But here share capital they are reducing from 10 each to 5 each. The difference 5 they are returning. That is called as distribution. So all these cases, number 5, instead of giving cash, they are giving loan to shareholders. So all these cases, company is liable to pay dividend distribution tax. All the 5 cases. On loan case, 30% dividend distribution tax, sir. Remaining cases, 17.472, 15% tax, 12% surcharge, 4% cess. And for 222E loan case, 34.944, 30% tax, 12% surcharge, 4% cess. This much dividend distribution tax company should pay, sir. And that dividend will be exempted in the hands of shareholders up to the extent of how much? 10 lakhs only. Sir, but if it is this one, it is fully exempted because company is paying 30%. So for shareholders, it's fully exempt. But in this case, for shareholders up to 10 lakhs only it is exempted. About 10 lakhs, shareholder will be liable to pay the tax. So are the provisions very clear? Since it's a revision session, we are main focusing on the core elements, sir, rather than discussing each and every aspect. So all the heads of incomes we have considered. So by this, our technical discussion on income tax is been completed. Tomorrow at the same time, 7 o'clock, we are going to discuss in the same way GST. GST we have 10 chapters. All those 10 chapters we are going to discuss as a revision point of view tomorrow. So inform to your friends also if they can use the same Zoom ID and password to enter into this Zoom classes. So you can inform to your friends also. So tomorrow we are going to begin GST session. Thank you. Thank you.